Thank you very much to you all, and thank you to the organization for this kind invitation in the Baltic AML Forum. That's a difficult one. I mean, session after lunch. It's a difficult one for two reasons. For you, after lunch, and for me, as a Spaniard, I come from Spain. You know that in Spain, after lunch, we normally have siesta. So I expect that, and I'll try to make it short so we don't have to do any siesta for all of us. So what I'm going to cover is best practices in implementing an AML model. So difficult to do it in 15, 20 minutes. So I'll do my best, at least to provide you with some ideas and insights on what should be the implementation of an AML model in a financial institution in general. Okay, so what I'm going to do first is I'm going to provide a bit of context, very short, and then I'll move forward to the topic itself, okay? So, well, in terms of context, somehow some kind of a general context. We are in a world in which regulation is really evolving very fast, and we have new regulation every year. I think we have been the whole morning talking about new regulation evolving globally, local regulation. Not just regulation, rules and guidances from many regulators and other bodies that the regulator expects that we implement them in our organizations. Okay, so here are a few examples. Also, in terms of general context, we are in a world where law enforcement has increased significantly, which in the end is regulator reviews, we're talking about fines, etc., etc. So we used to have these in the US and the UK, but in the last few years we have had this in all around Europe and specifically also in the Baltic region. Okay, going a bit more micro. What is the current situation that the financial institutions are facing? First of all, I would like to stress on risky markets and risky clients. Someone could say, well, we have had this already, always. It is true, we have had this always, but according to how the regulation is evolving, regulator pressure, I think we need to stress out that to deal with risky clients and risky markets now is challenging for our organization. So we need that our AML model is implemented properly to cover this. Also, new players. We have been talking a lot about these new players in the market. I'm talking about all the crypto and fintech companies. I wouldn't say that this raises the risk, but in the end, they are there. And it's for financial institutions, for legacy financial institutions, it's a new wall. And definitely, well, it places challenges which are new to us, and we need to have them there. So these implications need to be met, and if we don't meet the challenge, we have risky situations, okay? So just a few examples. If we don't meet the current situation we commented, we definitely might harm our customer experience, our most valuable client. Business continuity, I don't want to provide any examples. You know, this reputational risk, we don't want to be involved in AML. So just some context. Let's go to the topic. To me, to implement an AML CTF model has 4 basic pillars, okay? First one, risk assessment. We'll be covering this later in a panel. Second, all AML models, controls, and procedures that came out from the risk assessment. Third, technology. And fourth, our people and training. Okay, let's cover each of those slide by slide. So risk assessment. I don't understand the implementation of any model, AML, CTF model in any financial institutions without the proper risk assessment, okay? So if we try to implement an AML model in any organization with a proper risk assessment, I'm sure we will fail, okay? We need to understand the risk, our controls, our procedures need to follow this. This seems quite obvious, but we'll be talking about this, that this is not currently happening in many organizations. So left-hand side, just some insights of what should be an adequate and comprehensive risk assessment, okay? Define risk assessment criteria, assign inherent risk, detail the mitigating controls, and finally, identifying the residual risk. The main areas that the risk assessment should cover: countries, jurisdictional risks, presence or no presence in terms of non-residency, etc. All products and services, quite challenging sometimes when you are providing services to different jurisdictions in terms of names, different kind of products, etc. Distribution channel risks, also quite challenging now with all the digital world evolving, and group of customers, okay? Minimum risk assessment should cover in this. Let's talk about a bit on best practices on a risk assessment. Periodicity. Periodically review the risk assessment to make sure that takes into account new developments and insights, okay? Any risk assessment needs to be dynamic, not static. And need to be linked with our business area, with our commercial area, to make sure that any news, any new products are fit into the risk assessment. So therefore, we are able to identify the new risks. So periodicity, first one. Second one, methodology. Make sure we use a robust risk assessment systems and controls that fits the nature and complexities of our business, okay? So we need to use a robust technology. We need to make sure that this technology, that this methodology has, I mean, I don't mind, I've seen a lot of methodology from risk assessment, sometimes internal methodologies, Excel spreadsheets. You can build up a risk assessment in an Excel spreadsheet if it's done properly. And there are vendor solutions. It doesn't matter. I mean, the methodology needs to be robust, needs to be consistent, and needs to be dynamic. Risk factors. So make sure you have appropriately weighed risk factors which fit into the overall risk assessment. That means automate when possible and make sure that they are consistent between different jurisdictions that you might be applicable. And finally, very related to the first one, link and adapt each part of the AML model to the result of the risk assessment. Okay, there needs to be a link. Otherwise, if you do the risk assessment as an isolated exercise, this is going to not work. Second pillar, model procedures definition, which in the end is all the controls and procedures that came out from the risk assessment that we need to apply. Okay, so definitely all these controls and procedures should be applied according to the risk assessment. On the left-hand side, just an overview of the main pillars of any AML model: governance, due diligence, detection, analysis, and review. All of them, it is true that some of them, according to regulation, you need to implement them compulsory, but most of them, and basically due diligence and detection analysis, should be applied based on a risk-based approach that comes out from the risk assessment. You see, I'm talking a lot about the risk assessment, but to me, it's absolutely the base of any implementation of an AML model. So best practices. In here, I'm just going to focus, as I said at the beginning, on the risky markets and risky clients in order not to make it too wider, and a few insights on what are best practices in this area. Specific procedures for escalating the approval of high-risk clients. I mean, if you accept high-risk clients, this cannot rely only in first line of defense in business. I mean, there needs to be an involvement of compliance or the AML department. Having clear risk-based procedures, setting out enhanced due diligence required for high risk, this can be quite obvious. It is true. I mean, when I onboard a high-risk client, I have a checklist. I have to ask for certain documentation. But what about in the refreshments? So every year, high-risk client, more or less every year, or on a dynamic basis, when the condition of this client changes according to changes in the profile, is it clear in our internal procedures, the documentation I have to ask, how I need to have the customer file filled in documentation? And is the regulator going to accept whether the information I have in the risk files? Third one, Again, enhanced due diligence. What kind of enhanced due diligence are we doing on high-risk clients? Are we using external resources, corporate intelligence reports? I see still a lot of manual processes. So we'll talk about technology now, but we should move forward to, there are vendors, but you also can build up aggregators of information internally, which helps you to avoid manual processes and make sure that for high-risk clients, you get all the documentation rapidly. Paper relationships, which normally are obviously are considered high-risk customers, but need to be treated differently to a normal high-risk customer. So there should be periodic senior level review in order to manage the situation with PEPs. Appropriate refreshment, CDD on KYC documentation. I already covered a bit this. A few months ago, we carried out a study within KPMG on what was the level of expense of any financial institution in AML issues, and after technology, it was remediation plans in order to make sure that we have documentation on all our clients, so on refreshments. Okay, so second level of investment on any financial institution. And finally, transaction monitoring, which takes into account basically up-to-date all the KYC information. Make sure that when we do transaction monitoring, we use all the KYC information. That sometimes is easy if we have a vendor solution which link both systems, but sometimes it's not that easy if we have isolated technology. Technology, third pillar. I think it's quite obvious to say that today technology plays a crucial role fighting against financial crime. Okay, so on the left-hand side, on technology, basically, it is clear sometimes when you talk about technology, you always think of, okay, technology, I already have a transaction monitoring system. It's true, this is technology, but are you sure that according to your risk assessment, again, you have implemented the right technology where it can be applied in the different areas, controls and procedures? So in here you have a few examples of the different processes where currently technology is applied based on a risk-based approach, and different vendors offer different solutions. Okay, a few of best practices. I'm having a look at time to go one by one. I'll try to go one by one. Best practices and trends on AML and technology. Cognitive computing. Well, this afternoon we have a few sessions on technology, so I don't want to cover any of these, but cognitive computing is bring access to thousands of sources automatically. There are some organizations with a lot of people in doing manual processes in getting information in the opening process or refreshments. I mean, there are solutions already in the market, aggregators of information that do automatically in a few seconds. You get ultimate beneficial owners, adverse media in a single file. Make sure you are using these kind of solutions to do this. Machine learning. So machine learning algorithms that learn and detect and recognize suspicious behavior. So machine learning can be used as a part of the transaction monitoring. But I've seen a lot of financial institutions using it in order to reduce false positives. Okay, so creating a second layer using clustering techniques in order to make sure that we reduce manual process and we go to the manual to do it automatically. Graph analytics, cluster analytics. A lot of financial institutions are already setting up their internal financial intelligence units, which is basically doing data analytics, a strong data analytics, in order to make sure that we understand what's happening with our customers. Let's see if there are any relationships, groupings, etc., in order to fit our transaction monitoring system and to fit our analysts when they carry out the suspicious transaction analysis. Blockchain. I've seen a blockchain session later on, so I'm not going to cover this, but I've seen already a couple of banks using it to improve their KYC process in order to share information between jurisdictions where they cannot share names. So I'm sure that we'll listen to some examples on this. And then natural learning processing, also used for reducing false positive on the screening part, etc. Good. Last pillar, training and people. Quite obvious. People is our possibly after technology is our the most important asset of or together with technology, the most important asset of any financial institution. So when we apply an AML model, people is going to be our asset. Okay, so we need to have the right people in our model, and we need to train them properly. Okay, so first the ones on people. Make sure that when you deal with risky markets, risky jurisdiction, risky clients, you have the right people to do this. Okay. Second, make sure in your AML team, I mean, that's a bit tricky, but it is true. I've seen it in the market. I mean, a lot of legacy banks are full of redundancy plans, etc., and are moving a lot of people from areas to, okay, compliance department, AML department, analysts, which in the end, sometimes without analyzing whether these people has the right analytical and skills. So make sure that in your compliance and AML department have people with the right analytical and technological skills. In terms of training, also still a lot of financial institutions using general training, online training for all employees. Okay, so make sure you adapt and you segment your trainings according to the groupings of different people. So make sure you have trainings for sales representative, make sure you have trainings for the compliance and AML department. Board of directors should also be trained. In some jurisdictions, it's compulsory to train the board of directors in compliance and AML issues. And in the end, sometimes it's also, I mean, best practice in terms of training is train your analysts. Okay, make sure your analysts are trained properly. This will reduce definitely the amount of resources dedicated to that, and make sure the analysts receive all the information that it is generated in different parts of the AML department, the financial intelligence unit, and there is a link. I have some examples on financial institutions in which on a weekly basis there is a link between the financial intelligence units providing feedback to the analyst in order to make sure that they incorporate this in their analysis. Okay, so we have seen the four pillars, and 1 more minute on the main conclusions. So main conclusions for implementing an AML model in a jurisdiction like this one in the Baltic area. I would say 4 pillars, remember: risk assessment, controls and procedures, technology, and people and training. First step, and I'm going to insist 1 more in this, first step to implement an AML model is to carry out an adequate risk assessment. The risk assessment cannot be an isolated exercise and needs to be dynamic and robust. Make sure you use the right technology for your AML and CTF procedures, and invest in your people in training. Thank you very much.